A lot of people have been asking me whether they should defer their loan payment until 31st December 2020, which is part of government effort to stabilize the property markets in this COVID-19 situation. Is it really a profit or loss if you defer your loan payments? After doing a huge Excel sheet myself, today I have the answers for you. Hi, I'm Brian from Urban Agents Agent Incubation Program. For viewers outside of Singapore, we have been in a circuit breaker since April, which only allows essential services such as banks to stay open. Hope everyone is keeping busy while at home. On March 31st, Monetary Authority of Singapore released a package of measures to ease the financial strain on individuals and SMEs caused by the COVID-19 pandemic. Individuals with residential property loans can apply to their bank or finance company to defer either only principal payments or both principal and interest payments until 31st December 2020. A lot of you may have been put off by the clause published on MAS website. Interest will accrue only on the deferred principal amount, and no interest will accrue on the deferred interest payment amount. Does that mean I pay more to the bank if I defer my payments? Then should I defer or not? Before we answer that question, maybe you want to know how a loan is amortized over the tenure. Let's assume a loan quantum of 1 million, which is called principal amount in banking terms, with a tenure of 30 years and interest of 1.8%. Your installment is $3,596.98. Multiplying that with 360 months, we get a total cash payout as $1,294,914. Since you pay $3,596 each month, does your principal get reduced each month by $3,596? How much do you owe the bank after month 1 payment? Actually, out of $3,596, $1,500 is the interest payout, and the principal payout is only $2,096. So after month 1 payment, you owe the bank $1 million minus $2,096. If we plot that payment, it will look like this in month 1 and 2, month 101, month 200 and 201, and finally month 359 and 360. You will see that interest payout gets lower and lower each month because the principal is reducing, and eventually towards the end of the loan, most of our payout is principal payout and contributes to reducing the principal. If you like what you're seeing so far, please smash that like button and subscribe to this channel. That means a lot to our channel and will continue to generate quality content on property and data analysis for you. Now let's look at option 1, defer principal payout until 31st December 2020. Effectively, from May 1st until December 31st, you do not make any principal payout and only pay interest payout each month. An important assumption here is that your tenure does not get extended due to this deferred 8-month period, which is a default arrangement by most banks. That means your end date does not change even if you choose to defer. Let's look at the first 8 months of payments. The beginning balance is 1 million, and every month we pay only the interest payout. So the principal payout is 0. Principal starts at 1 million every month and remains at 1 million at the end of every month too. This was your original loan, 1 million with a 30-year payback period. After 8 months, you end up with a loan of 1 million and a payback period of 29 years and 4 months, starting from January 2021. The total cash payout is 8 months of $1,500 and 29 years and 4 months of $3,658, a grand total of this amount. It seems that you paid $1,500 interest payout for 8 months in vain. Most of you at this point probably think that deferring payment is only for the financially distressed and it will incur extra interest costs. Before you jump into that conclusion, let me tell you right here, right now, that you may actually be better off by deferring the payments. To get to that conclusion, you might need to understand what is a discounted cash flow first. DCF is linked to inflation, which means money gets cheaper and cheaper as years go by. For example, $10 can get you 2 McDonald's double cheeseburger today. But in 20 years time, maybe you can only get one double cheeseburger with $10. So if you owe the bank $10 and will only pay that amount in 20 years time, how much do you really owe the bank today? You will need to discount that $10 back to today. That's what we call discounted cash flow. We use a discount rate of 2% for inflation for illustration purpose, which is roughly the rate of inflation in Singapore. What you owe today is $10 divided by 1 plus discount rate to the power of 20, which is surprisingly $6.73 only. So with that in mind, let's look at the total payout with the discount rate of 2% as the inflation. The $3,598 in 30 years time is only worth this amount today. And if we discount each monthly payment of your original loan, the total payout with the discounted cash flow calculation is only this amount. Under the assumption that inflation is higher than the interest rate, you want to delay your payment to the bank as much as possible. If all the calculation is giving you a headache, the only thing you need to know at this point is, in a low interest rate environment, you can consider deferring the loan payments. Let's look at option 2, defer both principal and interest payout. This means you do not make any payment for the next 8 months, from May 1st to December 31st, 2020. Let's look at the first 8 months of payments. Your beginning balance is 1 million and every month you make 0 payouts. Hence, principal starts at 1 million and goes up by the accrued interest every month. The accrued interest is based on 1 million principal and stays the same throughout 8 months. This was your original loan, 1 million with a payback period of 30 years. After 8 months, you end up with a loan of $1,012,000 with a payback period of 29 years and 4 months, starting from January 2021. And the total cash payout is a grand total of this amount. Hold on, before we put in the discount cash flow calculation, again with a discount rate of 2%, if you choose to defer both principal and interest, your cash payout with the DCF is actually this amount. Now let's look at a summary of these 3 options. If you look at money as a nominal value, obviously option 1 is the best and option 3 is the worst. However, if you look at money with a factor of time, immediately you will see that option 3 is actually the best. Another factor is that you might get a chance to refinance your loan in 2021 to a much lower interest rate. Let's take it as 1.5%, and all the 3 options must be recalculated. In this case, the benefit of deferring payment is actually more significant than the original calculation. You can save almost $2,000 by taking option 3 instead of taking no action. The idea is very simple. If you choose to defer payment until 8 months later, 8 months of payouts will be shifted in time and pay back to the bank with a lower interest rate of 1.5% instead of 1.8%. And that gives you a better deal. If you would like to get a copy of my Excel to challenge my math or verify for yourself, please feel free to contact me via WeChat or WhatsApp. Hope you enjoyed the video and don't forget to comment, like and subscribe to this channel. I'm Brian Huang from Urban Agents Incubation Program. See you soon.